Okay, let's start. It's 4:02 already. Good afternoon, ladies and gentlemen. Welcome to ASK Investment Managers Quarterly Knowledge Series webinar. It's our endeavor and responsibility to update on our portfolios quarterly basis to our esteemed, valued customers and investors and our valued partners. My name is AVS Ramakrishnamurthy, and I am the moderator of today's call. Today, we will be updating on ASK Emerging Opportunities portfolio. To update on this, we have Mr. Chetan Thacker, portfolio manager, who is managing the Emerging Opportunities portfolio and along with various other portfolios of ASK. Mr. Chetan Thacker having overall 15 years of experience in portfolio management services, and over and above 10 years he was in a research side. So his domain expertise in agriculture, chemicals, metals and mining, and mid caps. Previously, Mr. Thacker was associated with McKinsey Company, HSBC Direct, MK Global Investments, and he's a CFA charter holder, and he did his PGDBM. Mr. Thacker is associated with ASK Investment Managers since 2015. See, before handing over to the Chetan, I will let you know the flow of this today's webinar. So Mr. Chetan would take us through the macros and micros and market outlook, and followed by he will be updating on ASK Emerging Opportunities portfolio quarter gone by, and followed by question and answers. Request all participants to type your questions in Q&A chat box. We will get the answers from the Chetan at the end of his presentation. Without further delay, I will hand it over to the Chetan Thacker. Over to you, Mr. Chetan.
Yeah, thank you, AVS. Good evening, everyone. Thank you so much for joining us for this quarterly update call on EOP. Like AVS mentioned, the way we've structured this dialogue is I'll quickly take you through the macro backdrop in which we are currently operating, followed by discussion on portfolio, what are the changes that we made, how have the earnings fared for the quarter gone by, followed that by market outlook from a more medium to long-term perspective, and we'll then open the floor for question and answer sessions. So starting with the macro backdrop in which we are currently operating. So what we are witnessing at this point of time is, and as we've been highlighting for the past few quarters, is that on the consumption side, on the domestic economy, we were continuing to see some degree of pressure on volumes. So volumes have remained muted. This is something that we've been highlighting since the festive season of last year. So it's probably the third quarter where we are witnessing some degree of sluggishness as far as domestic consumption volume is concerned. On the silver lining side, what is positive is essentially the fact that we started to see the benefits of a higher capex spend from the central government that has started to flow in as execution starts to pick up, particularly before the general elections, which are scheduled for next year. What we are witnessing is that capex is going on full stream as projects are getting implemented. It's visible in terms of when we look at the cement volume growth, which is 9% YOY in the current quarter. Steel consumption growth is 10%. We are seeing that visible even in segments such as cables, which are closely linked to industrial activity. So what we are witnessing essentially is that capex at this point of time is supporting domestic growth. Like we've highlighted, I think staples continue to remain muted. What we are essentially seeing is margin tailwinds are there for 2 quarters, which is Q1 and Q2, primarily because of a very benign base of last year. So earnings growth in these 2 quarters are expected to be driven primarily by normalization of margins, while volume uptake remains muted. Interestingly, even when we look at the entire volume scenario, the way it's playing out, essentially what we are witnessing is anything which is premium and above continues to do well in terms of volumes. So if you look at the volumes of the SUV segment or higher end two-wheelers, mobile phones, particularly the higher versions of mobile phones, LED TVs, which are upwards of 40-45 inch. All these segments are continuing to witness volume growth, while the mass segment continues to struggle. That struggle is essentially coming from the fact that we've actually not seen a full degree of recovery, particularly post the second wave of COVID. The expectation this time around is that as we head ahead, as we move ahead, I think higher capex spend, higher MSPs, should ideally lead to improvement in income on the rural and semi-rural side, which in turn will help growth on the domestic front. Further complication that has gotten added in the last 6 months is the fact that as the global growth has slowed down, We've also witnessed that China growth has not picked up as anticipated once they moved out from the zero COVID policy. What that essentially has meant is there is higher inventory sitting in the channel. Additionally, the channel itself was sitting on a higher inventory days. This was largely a function of supply bottlenecks, which we were witnessing, particularly during the COVID times. Hence, across industries, what we witnessed was supply chains were getting clogged, due to which consumers were piling on inventory, which was more than their normal inventory in normal course of time. So what we are seeing right now is a combination of two things. There is destocking that is happening because of slower growth. Further, there is destocking happening as most end user industries or end channels starts to normalize on the inventory days, because we've essentially seen easing off of the entire supply bottlenecks that we were visible in the last 2 years, particularly in COVID. Further, there has been a contraction in a lot of commodity spreads. That is a function of higher exports from China. China continues to sit on higher inventory. Our interaction with management suggests that probably we've seen maximum pain in Q1. That pain should ease off to some degree in Q2, but will still remain depressed. Essentially, Q3 is where there is an expectation of this leg of pressure easing off a bit, coupled with the destocking lever as well easing off a bit. On the positive side, what this essentially means is any user or end user of these commodities is essentially witnessing an upward movement in gross margins. That in turn will help expand operating profit margins, which were depressed in the last year first half. We are essentially seeing normalization of margins. We saw that in Q3. It was visible in Q4. It's accelerated in Q1. The expectation is this will continue as we move ahead. So in summary, domestic growth currently remains supported by capex. The expectation is consumption growth will start to kick in as we move ahead. Export growth also remains subdued, driven by destocking. The expectation there too is as we get to a more normalized stocking period, we essentially will see some degree of growth reviving in H2. Coming to the portfolio, what we've witnessed in the last 6 months is we've done a fair degree of changes to the portfolio. We have essentially increased weight in capital goods. We've seen weightages increase in pharmaceutical and healthcare. So if you recollect, for the past few calls, we were mentioning that there are certain pockets where we believe that weights need to go up. Pharma was one such pocket, healthcare in particular, which we had discussed. Auto was another space which we had discussed, and we've increased weight there as well in auto ancillary. And capital goods was another pocket where we felt that weight could move up. So we've finally added weight there. So primarily, we've essentially seen weights increase in these three pockets. Plus, we've added some degree of weight on retail as well. Moving on to how the portfolio composition at this point of time looks like. The mid-cap weight today is 49%. Small cap weight is 23% in the portfolio. So the portfolio is 72% largely mid caps and small caps, while large cap is 27%. Essentially, we've seen two of our names migrate to large cap category on the back of superior performance. So that is essentially increasing the weight of large cap. The idea, and when we had envisaged this product, essentially it was to identify names which are mid cap, small caps today. But eventually, if they deliver on the kind of expectations that we have from these names, we will probably will be more than happy to see most of these names transition to that bracket. Coming to the portfolio actions, so these are the entries that we've seen from Jan to July. We've essentially added IndusInd Bank in the portfolio. We've added TCI Express, which is a player on the logistics side. What we are essentially witnessing is there is a clear push in terms of getting the logistics cost down from 12% of GDP to closer to global benchmark, which is 8%. We are seeing efficiencies which are being recorded on the logistics side. Hence, we believe the opportunity size remains large. We fairly have a large presence of the unorganized sector within logistics. We are starting to see threshold of invoicing go down, which is a strong lever and tailwind for the organized play within logistics as well. So the expectation is this will benefit the organized logistics player, and as players look for more efficiency to be squeezed out of the logistics part of their cost curve. Coming to Alchem, Alchem is a predominantly domestic pharma company. We've added weight in Alchem here as we believe that domestic growth will continue to sustain. There is fair degree of operating profit lever which will play out in Alchem as we move forward. Go Fashion is a leading organized player in women bottom wear manufacturing and retail. That is one more name that we've added to the portfolio. Amy Organics is present on the pharma intermediate side. It continues to benefit from the tailwind of not only China plus one now, but even Europe has been an added lever as far as the entire space is concerned, be it chemicals or pharma intermediate, where we are essentially seeing this play out. Sansera is an auto ancillary player, dominantly present on two-wheelers, but has a fair degree of exposure on the non-auto side because of presence on the aero and off-road. Coupled with that, they have a portfolio of products on the EV side as well. So the order book has a higher percentage of contribution on EVs. So the expectation is, as the transition happens there on the energy side, on the automotive space, you will essentially see Sansera also being a player there. Sudarshan Chemical again is a chemical manufacturer. It's a leading pigment manufacturer in the country, has 35% market share. We've seen fair degree of consolidation that has happened globally as well on the pigments front. The expectation here is that with the CapEx cycle, which has got completed for Sudarshan, they've been able to plug the product portfolio gap, which in turn should benefit them as more and more players look to India as a sourcing destination for pigments away from China, which is the dominant player. The expectation is that with asset sweating, you will essentially see operating profit lever, margin lever as well play out in Sudarshan. Metal is more on the industrial consumable side. It has presence in automobile plus infrastructure. So that is another name that we've added to the portfolio. So we've seen fair degree of changes that we've done in the period of Jan to July, where we've essentially deployed the cash which was sitting in this portfolio and which we had generated. Coming to the financial performance in Q1, what we witnessed is we've seen operating profit growth of 25% for the portfolio. That compares with 14% growth ex of OMCs for Nifty 50. If one were to include OMCs, that growth for Nifty looks like 22 because you have a very benign base for OMCs. Last year, they had fair degree of higher losses, particularly from the marketing margin side of the business. We've essentially seen abnormal profits in this year. That is largely a recoup which is being allowed there. So there is a stark difference between the ex-OMC operating profit growth for the benchmark and profit growth including the OMCs. For FY24 and 25, what we expect is operating profit growth will continue to remain elevated at 26%. This is primarily a function of a benign base of H1, because of which operating profit growth looks higher for FY24. In FY25, we expect profit growth will be at 20%. This will primarily be a function of volume-driven growth. We expect volume to revive both on the domestic side in H2, particularly as festive kicks in. And also on the export side, the expectation is the structural changes that we witnessed, which the country's gone through, and the strong tailwind that is there, that should bode well structurally for exports, while there are near-term headwinds that we are currently dealing with. So FY25 earnings growth is primarily a function of growth, which will come from volumes. Margin will be a play, but it will be a fair degree of lower play compared to what it is in FY24. Coming to how the portfolio psychographic looks like, the portfolio as a whole has an ROC of 30%. It improves to 32% as volume growth picks up. Earnings growth remains strong at 36% and 30% for FY25. PE ratios primarily because of the correction that we witnessed in the portfolio last year, despite delivering 18% operating profit growth, that too has gone through a fair degree of contraction. So we are today at 26x FY25 as far as the valuations are concerned. Coming to the outlook, I think there are some silver linings. There are some degree of headwinds that are there. Coming to first, the headwinds that we are witnessing, monsoon has remained erratic, which has impacted sowing pattern. We are seeing some degree of that play through in terms of food inflation, which has recently inched up, which is translating to some degree of upward pressure on CPI. So that is more on the headwinds that we are witnessing at this point of time. Coming to tailwinds, I think strong tailwinds are coming in from the capex-led growth that we are witnessing at this point of time, that fuels more cash into the system. The second tailwind that is available is in form of increase in MSP. So while acreages are impacted, I think MSP increases which have been announced are higher than the acreage impact that we see at this point of time. That essentially means that while yields may be lower, we are still probably in the mid-season as far as sowing and harvesting is concerned. So if there is an impact on yield, MSPs to a large degree should be able to cushion the rural income, and that in turn will mean that we have fair degree of income growth on the rural side. When we compare this year versus last year, the positive thing is that this year festive season is positioned probably more towards the early part or the mid part of harvest. That means there will be monies in the hands of a large part of the population. Last year we had a festive season which was a month early, which essentially meant that it coincided with probably where it's a very early part of harvesting season, which meant that cash flow in the system or cash available to spend itself was lower. This time around, we see that getting postponed by a month, so that should ideally bode well in terms of cash available in the system to spend. From an exports front, I think, like I was mentioning, there is a strong tailwind. Companies are effectively looking at India. There is an added lever that is playing out, particularly because of cost pressures that we are witnessing in Europe and US. So not only are people now looking to move supply chains away from China, they are taking a more macro or a more global look at their supply chain and saying that, look, if we have a higher cost destination which has a structural issue, why not look at an alternate destination? And clearly, with the government policy on PLI, the ease of doing business that we witnessed over the last 5 to 6 years, India is very well placed because we have a very core advantage of a large domestic market, which can be tapped, coupled with which you can make India as an export destination as well. So tailwinds remain strong as far as manufacturing growth is concerned. Our expectation is from a more medium to long term, a percentage of manufacturing as a share of GDP should inch up as growth accelerates. It will be both driven by more backward integration as far as our import substitution on the domestic side, the growth on volumes on the domestic side, coupled with the opportunities that the export space itself will open up. So when we speak to management, very clearly inquiries remain strong, order books remain strong. What we are just witnessing is some degree of this destocking effect that is playing out in the near term, which we have to deal with, post which our sense is you will see a fair degree of acceleration there. So structurally, there have been a lot of changes that we witnessed in the last 4 to 5 years, be it PLI, be it IBC, be it entire digitization push that we have witnessed. So there are fair degree of structural drivers which are in place, which should drive both domestic and export growth. Our expectation is that as the economic growth picks up and where the country is in terms of per capita GDP, as the country grows richer, you will essentially see a faster growth which will come on the discretionary side of consumption. And that is more also a function of how penetration levels are in staples. Even within staples, our sense is anyone who has a premium portfolio will eventually benefit from a more medium to long term perspective as aspirations continue to remain high. It's a matter of time as money meets those aspirations, you will see growth accelerating as we move ahead. So I will pause here and I'll be more than happy to take any questions that are.
Thank you so much, Chetan, for your detailed presentation. Now, participants are requested to please type your questions in Q&A chat box so that we'll curate and we'll ask the questions to the Chetan. Chetan, before once questions coming to the chat box, so let me ask you the question that though you have explained about the business earnings of our entire portfolio in a detailed way, but if I talk about the business wise now across our 27 stocks, how the Q1 24 results went on, how many stocks are in line with our expectations, other way around. Can you have a comment on this particular aspect?
Yeah, so I think in terms of positive surprise, Polycab was a clear positive surprise as far as the results are concerned, where we essentially saw a fair degree of outperformance compared to what we were also anticipating. When we dig a bit deeper, it essentially ties in with what we are witnessing on the capex side. We've also seen KEI deliver numbers which are in line with our expectation. The entire financial exposure, even Bajaj Finance, has delivered numbers which are a tad bit better than what we were expecting as far as the numbers are concerned. The negative surprise was clearly more on the IT side. Infosys was one which negatively surprised us, and we have taken a more closer look and said that if there were opportunities available in our existing universe set, so we've essentially gone ahead. and replaced Infosys. So I think if we look at the results as a whole, I think IIT has been one where there is some degree of pressure. Our expectation is that while valuations there have corrected, but there is still some degree of time before this pressure starts to ease off. So on balance, I think the results have been tad bit better than what we were anticipating at the portfolio level.
Thank you, Chetan, for your detailed answer. Yes, the questions have started coming to your chat box. Yeah, a lot of questions are coming for in terms of the performance of emerging opportunities fund, because most of the investors are invested in our AIF platform. Let me, combine all the questions in one way that, despite of strong earnings growth, what we're seeing in the portfolio, and again, mid caps are significantly rallied. And if you see the relative performance with the mid caps, are also our portfolio has delivered last 2 years in emerging opportunities fund 6 to 8% IRR return. What is went wrong in our portfolio? Can you have some throw on light on the particular performance of the UF last 2 years?
So essentially, there is a fair degree of drag of last year's performance. Last year, what happened was, like I was highlighting, while we saw 18% operating profit growth, we saw a negative performance on the portfolio. Typically, given our style of investment, which is high quality, high growth, there is a fair degree of impact that happens if you see such a rapid increase in cost of capital. So that is one thing that has played out last year, which has essentially impacted valuations of the portfolio and not the earnings performance that we were expecting from the portfolio. Apart from this, I think a large part of drag last year was driven by financials. So our part of financials, or the financials which we own in our portfolio, while they delivered on earnings growth, what we essentially saw was the other part of the market on financials do well. That part was essentially witnessing an ROE expansion, primarily driven by rate hike. So the way it essentially functions is when you are going through this rapid rate hike cycle, you are able to reprice your portfolio faster, while your cost of deposit catches up with a lag. So what we've essentially started to see is only in November, where most of the banks have moved to increase cost of deposits. That meant that there was a fair degree of faster normalization on ROE. Credit cost also was significantly lower and below normal. That was largely a function of last 2-3 years. There was no credit growth from these entities. So practically, they had that advantage where they've not lent money, so you will not see credit cost. Going forward, I think where we are at this point of time, we've always been very cognizant and focused on picking entities which get all the three all the three parts of the triangle right, which is growth, asset quality, and the return ratio. So that is where we've always been focused on. So last year was probably a year where we essentially witnessed a period where, while earnings growth got delivered, we essentially saw the finance exposure not doing well. A second part of the drag was largely from the autos. So on autos, we have just one exposure, which is Sona BLW, which is, while it's on the right side of the energy transition, it is more closely correlated with what happens globally in terms of auto demand. While results for the last 3 quarters have been better than what we were anticipating, we essentially saw a fair degree of underperformance as far as the stock is concerned. There was also a technical factor where we saw one of the large shareholders exit out of Sona BLW. That also added some degree of pressure. But as we are seeing signs or witnessing signs of improvement as far as the volume growth on EV is concerned, we've essentially seen that stock bounce back as well. Third aspect was there were certain names where we felt that what we had anticipated for those names to play out did not play out. Be it India Mart, which was a part of the portfolio, Web of Global, Metropolis. These were names where essentially what we anticipated out of these businesses, that did not happen. What we've essentially done is that we've taken a more closer look and said that what do we want to replace that with, which meant that for some point in time, there was a fair degree of cash also sitting in this portfolio as we were finalizing names. Having finalized names, we've gone ahead and made a lot of changes in the last 6 months, which is what I discussed. So we've added 7 new names in the portfolio. The idea is, can we get rid of names which are weaker? Can we populate names where we still believe medium to long-term earnings acceleration will happen? So those are the actions that we've taken. We've seen some degree of early signs of both earnings growth accelerating, plus some degree of improvement on performance itself in terms of how performance has behaved. But we have catch up to do. So the aim of these changes is that we do that catch up. Historically, when we make a particular, so we've seen a 20-25% churn ratio for our portfolios. The idea is when we are making that change, can we add some degree of alpha as we make that change? So we made 7 changes. The expectation is each of these names, while they'll contribute in terms of compounding of earnings, there is fair degree of play that should happen as valuations also go through a period of re-rating. Apart from that, what we also anticipate, while we don't pencil that in, is at some stage you will get a tailwind of cost of capital moderating and going down, because we'll not see same quantum of increase as far as cost of capital itself is concerned. So we are keeping a very close eye. There is still 2% cash in the portfolio. We are still seeing how we can strengthen the position of the portfolio itself. There are names which are under evaluation. So at some stage we will take a call there. But we've been through a large part of the rejig exercise that we wanted.
Yeah, thank you, Chetan. The detailed explanation. Hope with the changes what we have done in the portfolio, we'll see the performance turnaround will happen soon across all the portfolios of the investors. Now, if you look into the performance while you're talking about that, yes, you're talking about which are the businesses underperformed for us and which has not done well for us. But there are some pockets where we observe that uh, portfolio given contributed very positively. Like consumer goods or industrial goods segment like Polycab and KEI. It has delivered close to 90 to 100% return for the portfolio last 1-2 years kind of thing. So what is your take on this particular sector, consumer goods and industrial, and what is the size of opportunity you're looking in cable and wire segment at this point in time?
So right now what we are witnessing is two things. One is there is a fair degree of acceleration in capex-led growth, which in turn is giving a strong tailwind as far as cables and wire as a segment is concerned. Real estate activity, despite increase in interest rates, is still chugging along well, and we continue to see that in terms of bookings that are happening. Apart from this, there is a fair degree of export demand that is coming in, particularly from US and Europe, because they are still going through their supply challenges. So what this combination has essentially meant is that we are probably running at near optimum capacity. So anyone who has capacity today can sell and make decent margins right now, because the new capacities are not coming up as fast. So we still see capacities that will start to come in a big way will be in FY25. So till that extent, we essentially see there is a strong tailwind. If you look at how the capex is playing out, you have capex which is accelerated, particularly on the railway side. You have capex that is accelerating on the power side. You have capex particularly on the renewable side. So all of these require a fair degree of cables that goes into these applications. So we are essentially starting to see that play out. We've always highlighted that the way we look at KEI, Polycab in our portfolio is these are direct play of manufacturing and manufacturing acceleration, along with what we see or what we expect them to deliver on the real estate front. So we have always believed that these are more closely linked to economic activity, manufacturing in India, and I think we are seeing some degree of tailwind play out in these names first. We expect the same will probably follow through in the other names also that we have.
Thank you, Chetan. There are questions coming from the participants on IT sector. If I combine all the questions what participants are asking, so there is a huge scope of opportunity in the mid-cap IT space, which is we missing in our opportunity action in our portfolio. There are a lot of good names in mid-cap IT space which are all doing very well. So what is your thoughts on IT and as well as mid-cap IT space at this current juncture?
So there is a dichotomy at this point of time. What we are essentially witnessing is there is a slowdown clearly as far as IT itself is concerned. So we are actually seeing discretionary spends getting delayed and pushed out. We are actually seeing signed projects also getting delayed in terms of execution. That is where the guidance for Infosys was largely cut when they came out with their earnings. While on the other hand, what you essentially witness is there are certain names within mid-cap IT. So mid-cap IT angel. So anyone who's exposed probably to the BFSI segment within mid-cap IT also is seeing some degree of struggle because that is a pocket where you've seen push out as far as discretionary spend is concerned. There are one or two names which are bottom up benefiting because of the way they've rejigged their portfolio. So in certain names, BFSI would have been absent completely, and that is a leg that has got added. Apart from that, structurally, we are actually seeing growth still remain strong, particularly on the ER&D companies on the automotive exposure, because you are seeing a sharp transition that is happening as we move to electric. So there is fair degree of opportunity that is opened up there. When we look at this landscape, I think certain names where the growth remains strong, we believe that valuations are a little stretched. So while we continue to look at those names, we are probably will take a call whenever we feel that they are in a fair degree of comfort zone. For IT in general, our view still is that while valuations have corrected, there is some degree of a headwind at this point of time. As this normalizes, you will essentially see large cap IT moving back to 8 to 10% kind of growth on the operating profit side, which should typically flow down to 12% kind of earnings growth. On mid cap, we'll have to be very picky and choosy. So we are continuing to do that. We have a lot of names that we've evaluated, but probably at an opportune time, if we see valuations also provide a comfort, we'll probably go.
Thank you, Chetan. Yeah. So in your presentation, you have mentioned about that, increase the allocations to automobile, especially in auto ancillary space. What are you looking in the OEMs? You have added new stock also in auto ancillary space, Sensor Engineering Limited. Can you please throw some light on sensor engineering side of opportunity and how it is going to benefit the entire portfolio? And why not OEMs in only auto ancillary at this point in time?
So I think on OEM for quite some time, we felt that with the energy transition that has kicked in, you will see some degree of shift that will happen as far as market share is concerned. And we are still probably in the nascent stage as far as that shift is concerned. So from a very near-term point of view, probably names where there was a fair degree of exposure on the entry level, which was suffering, you will see some degree of pent-up playout as income inches up. More structurally, we are still not too clear on which OEM will eventually gain market share on the transitioned ecosystem of EVs. Hence, we said that can we play this through auto ancillary, because auto ancillary to a fair degree has combination of three things. One is the normal volume growth that you will see. Second is increase in content per vehicle. That also adds to the growth. And the third opportunity itself is ability to add new customers. What is interesting on the auto ang side is for the first time, we are actually seeing a transition which is happening at the same time globally. So that essentially means the entire $2 trillion of automotive industry is up for grabs. So if you have a right set of products, it's not only domestic that you can cater to with that, you can essentially cater that on the export market itself. We've seen a fair degree of execution from someone like a Sona BLW on that front. Coupled with that, the fact that on the ang side, there is fair degree of sustainability of ROCs, while ROCs are broadly in the range of 20 to 25%. You don't have the advantage of an OEM in terms of higher ROCs, but you have a predictable ROC band coupled with a predictable growth band. Sansera is predominantly into two-wheelers on the connecting rod side. So they have an ICE exposure of 76%. As we look at the order book but has an exposure of close to 50% on the non-ICE side. So they are transitioning that is visible on the order book. While from a very near-term perspective, as growth picks up, you will essentially see some degree of pent-up playout even in two-wheelers. So if two-wheelers does well, they have a fair degree of exposure to someone like a Bajaj, TVS. If you essentially see two-wheelers do well, you will see some degree of that near-term pent-up playout. Plus, structurally, they have products on the EV side as well, which should benefit as we move ahead. Aluminium forging is another exposure that they have, and that predominantly will play out as most of the auto guys look to lightweight the vehicle, because that is a need of the hour on the transitioned ecosystem. Plus, they are a very strong, capable precision engineering company. So that is where the entire aero opportunity also opens up. So they have expanded capacity for the aero business. You are actually starting to see strong orders that have been placed with something like a Boeing and an Airbus, and they have a fair degree of play there. So that is where Sansera is placed. We believe that earnings should accelerate as we look ahead, and structurally there are a fair degree of tailwinds and size of opportunities which can be explored. Plus, like I highlighted, I think US and Europe are essentially seeing a severe pressure structurally on their cost curves, and they are looking at destinations which can move, where they can move parts as an alternate sourcing destination. India clearly stands out. I think it's our opportunity to go ahead and just grab those opportunities. And that is where we believe anyone who has a strong capability has a good right to win in that particular opportunity.
Yeah, thank you, Chetan. So there are questions coming for the consumption story. So if you see in terms of consumption in the presentation, you also mentioned that you are increasing weightages in retail and staples. So we are witnessing at this point in time the poor rainfall because of the El Niño effect, what we are expecting at this point in time. So how do you foresee consumption patterns in at least in the rural side of the consumption because of the poor rainfall and the crops what we are looking at this point in time, and also put some thoughts on discretionary consumption also because your weightage is more skewed towards the retail and staples. Can you have a thought on that particular aspect?
Yeah, so I think staples, we have just one exposure in the portfolio. That is more because we like this way the scale up can happen on the foods portfolio. It's Patanjali. If you look at consumption, like I was mentioning, near term, there is, yes, pressure on volumes that is predominantly coming in from how the environment has been as far as the rural side is concerned. So that is where the pressure is there. As we look forward more structurally, our expectation is that as income accelerates, you will essentially see discretionary where the growth will be stronger. You will see even within staples where there is a premium portfolio do well. So we are essentially positioned more towards the discretionary side of consumption, where we have a higher weightage, be it retail, be it the jewelry exposure that we have, be it something like polycab also, because they have some degree of exposure on the consumer durables front. So that is where we are largely exposed. We are largely exposed more on the discretionary side of things, and that is where what we believe will structurally do well from a more medium to long term perspective.
Yeah, thank you, Chetan, on your explanation. So now people are asking about again in the retail consumption space on the page industries, where we have witnessed in terms of valuations are also expensive at this point in time, and stock is also unfortunately not performing from last 1.5 years time period. And again in the same apparel side, we have added Go Fashions also. So what is your thought on this particular industry in the retail space? And can you also more some light on Go Fashions also, since you have added newly into the portfolio?
So I think Page, just to begin with, I think Page is going through currently an inventory correction process within their system and channel. So our expectation is you will still see some degree of weakness as far as Q2 is concerned on the volumes front, while volume should start to pick up from Q3. In terms of execution, what we've seen, what Page has done very well is that they've kept on increasing the size of opportunity. They started with men's innerwear, expanded to women innerwear, kids, athleisure, which has been a very strong growth driver. So very clearly, when you look at Page, probably a few years back, you would have said the addressable opportunity size is just 40 or 50,000 crores. I think today with increase and addition of all these other pockets, that addressable opportunity size itself moves upwards of 1,20,000 crores. Our expectation is that now that they have a good portfolio of products, I think EBOs will also make a fair degree of sense because you essentially have a fair degree of SKUs which you can populate in those stores. Our expectation is that once they are through with this inventory correction process, you will again start to see volumes start to inch up as far as Page is concerned. They are very clearly more focused on getting the penetration right. There is fair degree of scope of penetration itself compared to where they stand today. So today they would still be present more directly on the metro tier 1 to some degree larger tier 2 cities. So there is fair degree of scope of penetration led growth to play out in Page. Go Fashion, on the other hand, is very focused player on women's bottom wear. So if you look at the women's wear segment itself, where the economics plays out very well for someone like a Go Fashion is, if you walk into a store, given that it's bottom wear, it's typically stacked as opposed to kurtas or top wear, which has to be displayed, which means that you can very efficiently utilize the retail space that is available to you. Because in a smaller retail space, you have a higher throughput that can happen. Additionally, what we are witnessing is that there is a fair degree of shift that is happening from unorganized to organized, even within the entire apparel space. So that is an added benefit that will play out there. In terms of size, today they would have approximately 500 to 600 stores. So there is immense opportunity for them to grow. They are still predominantly a more metro and tier one kind of a player, largely metro. As the country gets more richer, as you see women participation in the labor force increase, the requirement of this garment itself starts to move up. So structurally, there are a fair degree of drivers there. Uh, they have been able to crack this segment well. So this segment has been a fairly crowded segment as far as the unorganized space is concerned. They have been able to deliver value to the customer in terms of price, in terms of the SKUs that they offer, in terms of the quality of the product that they offer. They probably would have started just with leggings, but they've expanded beyond that now. And they too are playing the page game where they are expanding the addressable opportunity size. So our sense is we can get 20% kind of compounding as far as someone like a Go Fashion is concerned, given their reach, presence today, and the availability of penetration-led growth.
Yeah,
With strong economics as far as ROCs are concerned.
fair. Thank you so much. Mr. Ashish Doshi is asking about the AMI Organics, which again we have added recently in our portfolio, again in a pharma space. And to ask that question in a other way, CT, there are more into, as you mentioned rightly, they're into the pharma intermediaries. Okay. I just want to the also participant wants to understand that what is the opportunity in the pharma ingredients, APIs, it's intermediaries where IPS, and then the the final drug will coming into the formulation kind of thing. So what type of opportunity you're looking, especially in the pharma intermediaries, and how AMI Organics is fitting into that particular basket?
So AMI Organics clearly is a player on the pharma intermediate side, and currently they have a fair degree of presence on the pharma side itself. What will happen as we move ahead is their core strength is the chemistry capability. So while today we see a fair degree of predominance of pharma intermediates, essentially as we move forward, you will also see them diversify into electrolytes that will play out. Plus, what we are witnessing from so in terms of size of opportunity, the entire intermediate space would be anywhere between 25 to $30 billion. What we are witnessing is two things that are happening. People want to move away from China. Even as they move away from China within India or any other sourcing destination, they want to make their supply chains all the more robust. Right? So if you move the intermediate bit, say, away from China to India, but you don't have a right to or a right kind of backend on the keys starting materials, then you are again dependent on China. So what our expectation is as we move ahead, what you'll witness is not only will the Indian companies who are present today on the intermediate side do backward integration, you will also see a fair degree of demand coming in because people want to move entire supply chain away from China. In terms of where the size of opportunity is and the size of this entity, we have legs to go as far as that is concerned. You will also see larger products coming in. So AMI Organics today has a fair degree of contribution from a lot of smaller products. Now, in order to scale this business up, you typically need larger products. We have seen contracts that they've signed with the supplier of Bayer for one of their pharma products, so that will start to kick in. And these are larger revenue products. So if you have to scale this business up from here, the key requirement is that you get in larger products into the portfolio, because that is what will provide you scale from a more medium to long term. If you have a larger contribution from a large number of smaller products, then your bandwidth gets impacted because of the number of SKUs that you are dealing with. So our expectation is that as this company continues to grow, you will see contribution that will start to come in from larger revenue products. You will see them diversify away not only from pharma intermediate, but to emerging opportunities like electrolytes, which will essentially happen. As you see battery manufacturing pick up over here, the first leg happens through PLI next year. As plants start to come in, they will look to move supply chains here. Even globally, what we are witnessing is that people want to move entire supply chain on the electric side away from China. So that is where India clearly stands out, because they don't want some degree of material exposure to China as well, because again, that will be an exposure where arm twisting can happen as far as those supply chains are concerned. So while currently AMI Organics is predominantly pharma intermediate with fair degree of products which are smaller in terms of revenue contribution, the way we look at this business evolving is you will see them get into larger products even on the pharma intermediate side. You will also see them diversify away from the pharma space as they look to exploit their chemical or chemistry strength.
Thank you. So there is another question from anonymous participant. He's asking about the Sudarshan Chemicals. And already the story has spun out. We are hearing Sudarshan Chemicals from long, but now why in emerging opportunities portfolio added? Can you have some light on Sudarshan Chemicals also?
So Sudarshan essentially has done a capex of 1,500 crores. So just to throw some light there, what we witnessed globally, so globally pigments addressable market for Sudarshan is $8 billion. What we've witnessed there is that industry itself has gone through a fair degree of consolidation. You've seen a lot of M&As happen there, by virtue of which Sudarshan has become the third largest player globally in pigments. Now the gap between the second and the third largest player is significant. What was missing in case of Sudarshan and where they worked in the last 3-4 years is primarily on the product portfolio. So they have diversified their product portfolio, added high performance products into their portfolio, added the missing products into their portfolio, because typically when you go to a customer or a distributor on the export market particularly, they would want to deal with someone who has a basket of products as compared to someone who has just 1 or 2 products and then dealing with other suppliers for those 1 or 2 products. So now in the last 3-4 years, they plugged that particular gap. They have plugged the gap as far as capacity expansion for these products is concerned. What has also happened because of M&As that have happened is that you have suddenly become a third supplier globally for a lot of these products. So typically the way the sourcing works is the top supplier gets 70% of the order. The second supplier typically will get 20% of the orders. The third supplier will get 10%. So far, Sudarshan was probably out of the gambit of that third supplier itself. But today now it finds itself at third supplier. Plus, you are seeing some degree of this entire shift that people want to do away from China. And that is where Sudarshan stands out. So our expectation is that they will continue to gain market share globally as well. They have a dominant market share on the domestic side. What happened in this interim period was we went through a period of fair degree of volatility, particularly on the input cost. Your price corrections typically happen with a lag. So you essentially saw them get impacted because of increase in raw material cost, which was not fully passed through as far as realizations were concerned. A higher power cost because of what we witnessed globally in terms of coal cost, and a higher freight cost. So we are actually seeing a lot of these negative things reverse now. So those have now converted to tailwinds as compared to headwinds. And they have capacities which are unutilized at this point of time. So as that gets utilized, as the mix improves, you will not only see acceleration in earnings growth, on the revenue growth, you will see a faster acceleration in earnings growth. So this is a story which was playing out well just before COVID hit us. And as COVID hit us, we saw this company go through a rough period, while the structural factors continue to get stronger in this entire period itself. So our expectation is that structural factors will play out now. They are positioned well, so you should actually see acceleration in earnings.
Yeah, thank you, Chetan. We'll take another couple of questions to capacity of the time. So Mr. Ravindra Mathur is asking about on the Divi's Laboratories performance. He was mentioning that it is performing poorly. Why are you holding still on it? Can you have some light on Divi's Laboratories?
So Divi's also similarly, like I mentioned, is going through a rough period of where customers are adjusting their inventories. So what we witnessed in case of Divi's also is as COVID was playing out. So there are 2 things that happened. One is you have a higher base because of the COVID-related drug, Molnupiravir, that has played out there. So obviously that opportunity is gone away because it was a COVID-related opportunity. Well, that has given a fair degree of cash flow to this entity to go ahead and deploy in their planned capex. The second aspect, particularly on the CSM business that has happened, was that we essentially saw their customers increase their inventory days because they felt there will be fair degree of supply bottleneck. So we are actually seeing some degree of correction that is happening there as well, because of which the near-term numbers look to some degree depressed. As we stretch this horizon out, our sense is that you will, one, get tailwind of normalization of what is happening in terms of inventory. Two, there are new products that are coming in, particularly in contrast media, that will start to contribute as far as revenue is concerned in second half of FY24, more so in FY25. Three is the margin lever will also now play out, because historically, if you look at DVs, they were in the margin range of anywhere between 35 to 38%. We removed the positive effect of the COVID-related drug. They were still operating in the band of 33 to 35%. They slipped down because of all these factors to 25, 26%. Our expectation is they can eventually move back to the more normalized band of 33 to 35%. So we will actually see earnings accelerating there as we look ahead, while the strength of DVs continues to remain intact. So I think they too are going through. So in the early part of the pandemic, they probably went through a surprisingly very robust period. What we are witnessing right now is some degree of correction as far as supply chains are concerned, because those supply chains had got used to the supply bottleneck. So as they get reused to the old environment back, where things could move in 25, 30 days, we will go through this patchy period of supply adjustment, post which we will get to more normalized growth. And you will see DVs continue to play on their strength of the CSM business by adding more products into the portfolio.
Thank you so much, Chetan. Fair. So Mr. Sagar Kapadia is asking, he wants to understand on why are you not participating in PSUs, power or infra, or heavy engineering companies, kind of thing. Can I have thoughts on that particular aspect?
No, so while we evaluated and we continue to evaluate that space, I think one name where we were confident to go ahead and start allocating weight was Kena Metals. So that is what we started to do. On PSUs, I think we are being very selective and choosy about the PSUs that we want to participate in, because we've historically seen that there are too many stakeholders in PSUs to manage. So there is a fair degree of risk which does not look apparent when things are going very right. So we are being very cautious on choosing PSUs and where we want to participate. So I think in that entire pocket, we made a first entry. We continue to evaluate names there. If we believe something qualifies, we'll surely go ahead and add that in.
Thank you so much, Chetan. The last question for the session today, that in EOP you're showing the presentation that in terms of market caps in small, mid, and large, still 27% of large cap we are holding in emerging opportunities portfolio, 66.5% we are having in mid and small cap kind of thing. So participants just want to understand that you would like to continue the same proposition in the large cap 27%, or you want to run this 100% as a mid and small cap portfolio?
So we'll predominantly remain a mid and small cap portfolio. I think the exits that we've made, so there were 2 exits. I see a question there on exits as well in the chat box. So while we discussed Infosys, we also exited out of Reliance from this portfolio as we saw opportunities which were available on the more mid cap, small cap side. So that should have ideally reduced the weight of large caps. But what we've also witnessed is something like a PI or a Berger Paint has moved into the large cap category, because of which you see the weightage that you see there. We'll continue to remain predominantly, when we look at names, we'll continue to look at mid caps and small cap names. Only if we see an opportunity which a large cap is well placed to exploit, will we go ahead and look at large caps, while we continue to remain focused on identifying mid caps and small caps which fit our investment philosophy and the character that we typically look at from the businesses. So it will remain predominantly that, while some degree of weight of large caps will shift because of what we've even see shift right now as market cap itself moves up.
Thank you so much, Chetan, for your patient answering all the questions which participants are asked at this point in time. Thank you so much, participants, participating in this webinar. And if you have any further questions, kindly reach out to our relationship managers in your locations. So we're happy to answer all those questions offline also. With this, we'll end this webinar today. Thank you, participants. Thank you, Chetan Thacker, for your time.
Yeah. Thank you
Very
everyone for
clearly.
joining us. And like AVS mentioned, if there are any queries that have remained unanswered, please feel free to bounce them off your RMs. They will bounce it off us. We'll be more than happy to answer all the queries that are there. Thank you so
Thank you so
much.
much. With this, we'll end of the session. Thank you so much.